Hello everybody. On this video I'm going to explain compound interest, annual percentage rate and mortgage calculations. You might think why I'm doing this. I do think I have seen many YouTube videos some people produced and presented. I think most of them just give you roughly idea, but they do not really exactly tell everything. I intend to tell everything, although what kind of mathematics involved in it, and how it is easy to check through compound interest when you borrow money, on credit cards, especially this is a big case at the moment, and mortgage calculations. Now, as you know, this is a very interesting subject. So many people borrowed money, and most of them on credit cards. Sometimes companies put their charges higher, because if they put 1% extra charge per month, consumers or borrowers cannot understand how this is happening. That's why I wanted just to start with the key points first of all. It's best to know actually what I'm saying here, what interest rate you borrowing the money, because this is interest rate, annual interest rate, which is APR. Every company must declare it by law, and you must sign for it. From that per year APR rate, you can work out backward to get your monthly interest rate, because you get your statements every month, and you can see sometimes the fluctuates this interest rate. You must always ask your company, say, look, I want my monthly interest separately section, a line, say my interest per month this month was this one specifically, and then minimum payment on top of how much from the capital you're paying on top of that. That's important. If you have any disputes, obviously you're not happy with it, you must make your complaint in writing to the company. If you do not receive a good satisfactory answer, and then you can go Financial Ombudsman Service, which is appointed by the Financial Service Authority. These are mostly in England, in UK, where I am at the moment, but I'm saying this is all apply all the countries involved, English speaking countries as well. Let's just go into the mathematics of these calculations. If you go a little bit further down, just 1 second. What is APR? APR is actually annual percentage rate, shortly written as APR, which is, it's a number, 8%, 10%, 12%, some 3%, 4%, whatever. Just I want to show you how you get monthly rate, because I've seen in many videos here, I must really point out this, I have to point out to yourselves. Some people say if it is 12% per year interest companies are charging, from there to find out monthly they just divide it by 12. It is not like that. It is not a right proportional, because compound interest is actually not proportionally or orientated. It is actually compound interest is parabolic, is like exponential. So from that point of view, you find out, for example, if it is a 12% end of the year, if you see in there that's monthly rate, you find out the money has to be 100, not 100%, just as 0.9488 extra. Because if you expand it from monthly to the end of the year, 12 months later, you have to get 12%. But if you do that most people do it, you cannot get it like that. It's always fluctuates up and down, So just to show you a little bit more an example, if you say £5,000 you invested after 15% interest rate you might just think, 5,000 I invested, I want to make it for £15,000. They give me good interest. Sometimes this is a case. Sometimes on investment sides, gilt ages or government bonds, sometimes, if it depends on the money, growth rate, and you might think, how long later I can make my money, 15,000. Well, from that 15 rate, you work out for your monthly rate. Money stays there for 24 months, 36 months. How much increases? 52%, 74%, two times, 2.31 times. You go to it. Just if you find after 7 years, 11 months later, you found 3.0193, which is nearly 3 times, or a little bit over, That's the way it goes. Mortgage thing is quite different. When we come to borrow big money, buying a house, that's quite different. I think this is you have to be more careful about this one, because sometimes building society financial houses, the prices, interest rates keep changing every year. As the Bank of England changes the interest rate, everything keep changing. From that point of view, it's better have a look at it. And I put it as a case on this video. I'm saying exercise. I borrowed £120,000, which is first time buyers, 4.5% current interest rates, and monthly payments £700. Repayments maybe 20 or 25 pounds. You can borrow money. After initial £220,000, you put the interest on top, because the rule on the building societies, mortgages, you must put the interest, total interest, at the beginning of the year. That's the way building societies, mortgage people work. If they lend the money to you at say 4.5%, they put the money on top of the borrowing at the beginning of the year, from the first month. So if your payments are good enough, big enough, during the year, 12 months period, you try to beat that interest amount, plus you go forward, try to pay from the capital money. That's the way go round. I just made it, show you each line. Loan 120,000, interest 5,400, payments 8,400. Outstanding balance this. This is only first year. Second year, you do the same things. Outstanding balance exactly £113,000. If you go a little bit further, these calculations, year 1 as you have seen, year 2, after n years, n here represents say 5 years, 10 years, 15 years. If you kept it going like that, this is an example, because we thought everything stay the same 5 years, 10 years. You have to be in command of everything when you're paying this money. This is a formula. That formula generalize in a way at this like that, because it is a kind of geometric series comes out of it. 120,000 times 4.5% interest rate, n years, and power of the n, 10 years. Just to give you another example underneath, just to show you. If you go a little bit further up, say this right hand side of this formula, there is a sigma expression that represents a geometric series, and that's the total of it. Usually it's given like that as an end, total. If you put it back again, substituting, you get this formula. After 10 years, just to say you borrowed this money 4.5 years, percent interest rate, and that's the repayment, £8,400. What will happen? Your balance, because you borrowed 120,000, you put n into the equation. N equal 10 you put in this equation, you work out step by step, you get £83,124. But in the mortgages, you borrow money, you pay for it, you pay for the interest plus from capital money you owe. But by that time, 10 years time, most probably your house value in twice. For example, you borrowed say £130,000 a house and you pay 10,000 deposit. After 10 years, you're paying this money. You still owe 83,000 to the mortgage company, but your house may be £250,000. So that's the beauty of it, I hope this information is useful for credit users as well as mortgage takers. If anybody interested in the Word or PDF format of this everything I have done it here, I am happy to send it to you. Thank you for listening. Bye.